This is Nightly Business Report with Tyler Matheson and Susie Guerra. Brought to you in part by
TheStreet.com, featuring Herb Greenberg, who reminds investors that risk is real. With Herb Greenberg's Reality Check, researching stocks in terms of risk. You can learn more at TheStreet.com/realitycheck.
New highs. The S&P 500 closes above 1,900 for the first time ever. And our market monitor guest has three stocks he says will gain 25% in 18 months or less.
Rebound, new home sales rise, so do home building stocks. So is it time to invest?
And the pressure is on for drug companies to lower their prices. And leading the push is the nation's largest pharmacy benefit manager. We have all that and more tonight on Nightly Business Report for Friday, May 23rd.
Good evening, everyone, and welcome. Who says not much happens in the markets on a Friday before a long holiday weekend? Despite light volume, investors pushed the S&P 500 to a new record closing high, closing at 1,900, basically on the button for the first time ever. Stocks got a big boost from better than expected new home sales last month, and we'll talk housing in just a moment. For the week, the U.S. markets had their biggest gain in more than a month. The beleaguered Russell 2000 and the recently pressured NASDAQ each gained more than 2% this week. The Dow Transports closed at a fresh all-time high today. And here's how the major averages finished for a Friday heading into the holiday. The Dow up 63 points. It's now higher for the month of May. NASDAQ was up 31 today, and the S&P 500 added 8.
Well, as Tyler just mentioned, there looks to be a spring thaw in the U.S. housing market. Sales of newly built homes recovered in April, shooting up a better-than-expected 6.4%. That follows 2 months of sharp declines. That helped lift shares of some of the nation's biggest home builders. D.R. Horton and Lennar jumped 4%, and Hovnanian and Pulte Homes also posted big gains. So is it time to invest in the sector? Joining us to answer that, Bob Brusca. He is chief economist with Fact and Opinion Economics. Bob, I know you're not very optimistic about the outlook for housing. Tell us why.
Well, I think that we've got a lot of headwinds in the housing sector. We've got, first of all, an unemployment rate that's low, but not because people got jobs, but because they've dropped out of the labor force. And so those people aren't going to be home buyers. We've got an economy that generally isn't growing that fast. We've got still a difficult time getting financing. A lot of banks are still very careful. They've gotten their hands burned in the past by lending in the housing industry, given some of the government policies. And so they're wary. And so housing financing isn't there. And we've had a hard time getting first-time new home buyers in. They just aren't able to qualify because of the credit standards that banks put in their way. And so as a result, when they try to buy a house, they're trying to buy a house at a much higher mortgage rate than people with the best credit ratings. And so these are headwinds that you have to face if you're a new home buyer.
Let's bring in Will Randall from Citigroup. Will, welcome. You were with us last fall. At that time, you were pretty optimistic about housing. How does your mood on housing compare today to what it was then?
Sure. Real quickly, I mean, we upgraded a lot of our stocks back in early December as we saw sequential momentum above the normal pace for November sales. We then downgraded early March because we saw some market softening. Now, this is very local, specific markets. It's not particularly the whole nation. Plus, we had some cold weather. How I feel today? Good, not great. I would agree the first-time home buyer is a much smaller percentage of sales. I call it 1/4 relative to 40%, if you go back historically. That being said, let's not forget the FHA head has just changed. It's Democratic bent. And the FHFA, which does about 75% of mortgage production, is now saying they want to play ball with the banks. So I feel a lot better than I did when we downgraded those stocks in March.
Bob, react to what Will was saying, and also I'll just add in another, what I think is a positive development. We saw mortgage rates this week dropping across the board. The 30-year mortgage is down to 4%.
Yes, mortgage rates have come down a little bit, but, really they're oscillating at a pretty low level right now. I don't think they're changing very much, and I don't think this drop is going to cause people to be able to go over the affordability hurdle. As far as the regulations, the changes in the way that some of these agencies are going to deal with banks, I think that you have to be careful. The banks are going to be, I think, somewhat wary because they've been burned in the past. So there's a little bit of good news that might be there for home buyers in the future. But I think you have to be wary. The banks are going to be wary about thinking that this is a new regime, because it's still a very difficult world out there for lenders.
Let me get both of you to answer the following question. Bob, when I hear you say you're not optimistic about housing and you see a lot of headwinds for housing, does that suggest that you think house prices on average nationally are going to fall a year from now from where they are today? And Will, would you answer the same question? Bob, you go first.
Yeah, I don't think you're going to have much gain, or you could have a decline. House prices have increased a lot. New home sales are already lower year over year, so we've already seen that happen, and I think that they're going to be challenged moving forward. Although I do think activity in the housing sector will improve a little bit, I don't think it will improve by much.
Will, do you agree with that or disagree?
I would disagree from the perspective of that house prices go negative, all bets are off, because sentiment will die for housing. If that happens, all bets are off. That's the first point. Second point here is I do think we will see improvement, and we will see moderation in home price appreciation. That's natural. Why? Because inventories come back to the market. If you look at the case, Schiller will be up 7% instead of 11% within the next 2 months. That's not a bad thing. We need moderation, and that's good for housing.
Will, I know you've been just starting to recommend a few of these home builder stocks. Which ones do you like and why?
We recently upgraded D.R. Horton, ticker DHI, and Masco. Really what it came down to is we thought we were getting kind of a bottom in terms of sentiment for the stocks, number one, and more importantly, the regional diversification is important here, because if you look at some of the Southwest markets, that's where it's got a little frothy, that's where it's got a choppy, and that's what we're worried about. These guys have national exposure, so they should benefit from easier comps in the second half, which a lot of people aren't focused on. All
right, gentlemen, thank you both very much. Have a great weekend. Appreciate you coming on the program tonight.
Thank you.
Will Randolph from Citigroup, Bob Brusca with Fact and Opinion Economics.
Well, one of the biggest gainers in the S&P 500 today was the computer giant Hewlett-Packard. Shares up about 6% after earnings late Thursday were pretty much in line with forecasts for the latest quarter. And the nation's #1 PC maker announced plans to cut another 11,000 to 16,000 jobs by October. CEO Meg Whitman explained that the newest job cuts at underperforming units are all part of her multi-year restructuring plan.
Remember, we're managing a portfolio of businesses. We've got some businesses that are declining, some businesses are holding their own, and some that are growing quite rapidly. So if we can continue to grow the fast-growing businesses and stem the decline in the big legacy businesses, then maybe it'll turn out the way we hope.
Hewlett-Packard says the new job cuts will save an extra $1 billion annually within 2 years.
Another iconic American company is also undergoing some big changes. Time Warner is spinning off its storied magazine publishing division, forming a new company called Time Inc., and that will begin trading on its own next month. Morgan Brennan has more on what's behind this move by the media giant.
Today was the last day you could buy Time Warner stock and expect automatic shares in this new company as well. Time Inc. will have 45 websites and 23 magazines, including People, Fortune, and its namesake, Time. Experts say the spinoff will allow Time Inc. to focus on a sweeping redesign.
For Time Inc., this frees them now to pursue what's best for them in terms of a corporate strategy, a capital strategy, and you've got a built-in shareholder base because you're spinning this off, obviously, out of the Time Warner holders.
The emerging company's already making big changes, announcing it will trade its Time and Life building for less expensive offices in Lower Manhattan near the World Trade Center. And it's experimenting with unprecedented ads, running them on the front of Time magazine and Sports Illustrated. For Time Warner, this marks the end of a 7-year restructuring, having spun off Time Warner Cable and AOL before this. It means the parent company can now focus exclusively on TV and movie content, namely Warner Brothers Studios, TV networks like HBO, CNN, and TBS. Time Warner's following in the footsteps of other media giants that have separated assets to become pure-play content providers like Viacom and CBS and News Corp and 21st Century Fox.
Decommissioning or deconglomerizing those elements puts them back in a place where the dynamics for film production, film distribution, television distribution are much more interesting to investors, much less capital intensive in many cases, And certainly, investors have responded very favorably in each of these companies to these different dynamics.
The question now will be whether Time Inc. can stand on its own and attract investors, because the publishing industry continues to struggle as more people abandon hard copies of magazines in favor of the web, where they can access the same content for free. For Nightly Business Report, I'm Morgan Brennan in Los Angeles.
Some harsh words from Russian leader Vladimir Putin about President Obama and the U.S. today at an annual economic forum in St. Petersburg, Russia. But Putin admitted the tough economic sanctions against his country for its encroachment into Ukraine is already affecting the economy there. Our Jeff Cutmore has more.
An apparent softening of the Russian president's position on the Ukrainian elections over the weekend saw the ruble spike to a 4-month high. But the president had some hard-headed words for Mr. Obama in the White House, effectively criticizing Mr. Obama's comments, saying that the Russian president was on the wrong side of history over the Ukrainian crisis.
Who is he to judge? Who is he to judge? Seriously. If he wants to judge people, why don't he get a job in court somewhere?
I asked President Putin about his view on the sanctions that had been imposed on Russia. He again very unhappy with the sanctions and said that they had had an impact on the Russian economy.
These sanctions are absolutely illegal, unlawful, and of course they decrease, they make our relations worse. We're now hearing about the third package of sanctions, and I have a question in that regard. Why?
The message, though, that will come out of the president's comments today, that he will respect the choice of the people when it comes to the presidential elections on Sunday in the Ukraine. This is Jeff Cutmore for Nightly Business Report in St. Petersburg.
And still ahead, the price is wrong. What one of the largest pharmacy benefit managers is doing to get drug makers to lower the high price of specialty drugs.
We told you last night about the new hepatitis C drug called Sovaldi. It costs a staggering $84,000 for a 3-month treatment. There's been an uproar over that hefty price. Now, one of the nation's largest pharmacy benefit managers is launching a campaign to get the drug's manufacturer to lower its price. Bertha Coombs has more.
Express Scripts' Steve Miller is in the business of reining in high drug costs. When Gilead Sciences priced its new hepatitis C drug Sovaldi at $1,000 a pill, he denounced it as downright unfair.
If you look at the price of treating hepatitis C, it went from just 5-6 years ago at $25,000 to then there were some newer drugs that came out at $50,000. They're taking a premium on a premium on a premium, and we think that's not sustainable.
Express Scripts projects hepatitis C drug spending will double in the U.S. this year and increase 200% in 2015 and 2016.
The cocktail to treat the patients is going to cost well north of $100,000 per patient. We have 3 million patients in the United States that have hepatitis C. That would be $300 billion to treat them all.
Dr. Miller has launched a crusade to get insurers and employer health plans to push Gilead for a lower price and hold out for new drugs due next year.
If a product comes out that's less expensive, we're going to move our entire market share to that.
Gilead defends Sovaldi's value as a cure for the Hep C virus, which now causes more deaths in the U.S. than HIV. In countries like Britain with universal health systems, the drug maker has discounted the price. Drug industry consultants say the chance U.S. regulators will pursue the same strategy is slim.
I don't think our country is ready to stomach drug negotiations and drug regulations to that extent.
But with more high-priced specialty drugs in the pipeline at a time when more Americans are gaining health coverage, some analysts say it could be a matter of time.
We have a number of new breakthrough cancer therapies that are likely to come to market in the next few years. It will place a huge burden on payers.
Some drug makers have joined Miller's coalition and vowed to find a solution. Gilead isn't one of them.
We have got to come to a sustainable model in the United States.
Dr. Miller says the pharmaceutical industry has an opportunity to act now and work with payers. If not, they may well find themselves dealing with government control. Bertha Coombs, Nightly Business Report, St. Louis.
Shares of Aeropostale plummeted after Morgan Stanley issued a warning about the teen retailer, and that is where we begin tonight's market focus. The firm's analyst questions the company's ability to stay in business even through next year, since it's been burning through cash amid mounting losses. Late yesterday, the retailer reported its sixth straight quarterly loss and issued a weak outlook. The stock fell almost 25% to $3.41. That won't even buy a T-shirt. Shares of Aruba Networks also got hammered in today's session. The computer networking company reported earnings that were in line with estimates and sales topped consensus. But analysts at J.P. Morgan said its gross margins were below estimates, and the firm reiterated its underweight rating on that stock. Aruba down almost 11% to $17.89.
Shares of PTC Therapeutics shot up after European regulators recommended the conditional marketing approval of its muscular dystrophy drug. That lets patients with the disease get the treatment. The stock surged 31% to $20.03. And Google is reportedly nearing a deal to buy Skybox Imaging for about $1 billion. Skybox specializes in recording very detailed landscape pictures and videos. Shares of Google were up 1.5% to $563.80.
Our market monitor expects lots of noise and volatility to drive the markets over the next few months, but he says fundamentals are key to getting from point A to point B in the long run. He's Don Wardell, portfolio manager at Ridgeworth Capital Management. Don, welcome. Good to have you with us. You expect volatility to pick up? It's been very, very low over the last month.
Well, I mean, I guess the more important thing to know is, like you said, fundamentals will get you from point A to point B, but there's always going to be some bumps along the road. Like we experienced over the last 5 months with the polar vortex and some geopolitical unrest that always seems to strike fear into market participants.
You have a couple of stocks that you think are going to do well in this world that you just described. You said that 3 things are guiding them. Tell us what they are and tell us why you like Ameriprise.
Sure. So for a stock to get into the portfolios that we manage at the Ridgeworth Mid-Cap Value Equity Fund, stock has to have 3 things: dividends, valuation, and fundamentals. When all 3 of those come together, like they do for Ameriprise, that's a stock that we have a big position in. Ameriprise has a 2% dividend yield. The company's valuation is very attractive relative to other asset managers. Some folks would say it's a life insurance company, and true, historically it has been, but the asset management, wealth management part of the business is growing, and so the company is going to get a higher multiple for that better return business, and we really expect the productivity of their sales force to improve, and we also are expecting some very solid flows to begin in their asset management business. And so we really think that there's a material upside in this stock over the next 2 years.
A second stock that you like, in fact, that you think, as these other 2 that we'll mention here, can grow 25% over the next 12 to 18 months is Cigna. Why?
Well, Cigna, I think, is one that could experience some volatility, but at the end of the day, patient investors will be rewarded. As the market gets comfortable with the move to the exchanges model, where you have private exchanges and public exchanges, and we bring all of these people into the healthcare system, this is a company that's going to do great things. Their dividend is small at this point. We expect that to grow over time. They've done a complete restructuring of the business by selling some non-core assets and buying back shares. And we think that the ultimate earnings power of this company is well above what the street has modeled. And so I think that these companies, all these managed care organizations, whether it be United, Aetna, WellPoint, et cetera, we think they're all going to re-rate higher as they get more stability, more consistent quarterly reports, and that's why we think Cigna can do very well from this point.
Ingersoll Rand is another one on your list. It's closed today at $58. Tell us why you like it, and where do you see the stock closing down the road?
Yeah, sure. So Ingersoll Rand is a different animal in that this is an industrial company. They've done some really great things. Again, our process is dividends, valuation, fundamentals, and so the company has roughly a 2% dividend yield. The valuation is in line with its peers. But we think the fundamental story is the expected cycle in front of us for construction, whether it be residential or non-residential. Ingersoll Rand makes air conditioning, HVAC equipment, and we think that they're products are positioned great. We think that we're on the front end of what could be we're beginning to see the grass green shoots, so to speak, of a non-residential construction cycle. We think that housing will continue to build, and they're going to do some non-core things there as well by moving some businesses out and into this company and buying back stock. Got a ton of cash to grow the dividend and buy back stock. So we're really encouraged by what we see there and think that Ingersoll is going to do well at least over the next 12 to 18 months.
We have to leave it there. Any disclosures on these stocks? You mentioned that you did own, or your company owned, Ameriprise. I assume you have money in the other ones too.
Well, yeah, my ownership of these is through the ownership of the mutual fund, yes.
All right, Don, thank you very much. Don Wardell with Ridgeworth Capital Management.
And coming up on the program, the benefits available to service members and veterans that many don't know about. That story is next as we head into Memorial Day weekend.
New York City may be America's financial capital, but New York State has a long-standing reputation as, well, just not the easiest place to do business. Now, Governor Andrew Cuomo has launched a multi-million-dollar effort to change all that, and if it works, it could bring the already fierce competition between states to a whole new level. Scott Cohn has more.
Why is our Arizona-based company relocating manufacturing to upstate New York?
The ad campaign alone is costing $15 million to make it look like businesses are flocking to New York.
And now it's even
ValueTech CEO Greg Hyland is one of the stars.
I think there's a new edge to New York and wanting to be competitive and wanting to attract high-tech companies. And I thought, hey, let's have a little fun with this.
ValueTech, which makes supplies for high-tech manufacturing, is only bringing about 25 jobs to a workforce of nearly 9 million. Overall job growth in the last year is behind the national average, and New York consistently ranks among the most expensive states. High tax, high regulation, high stress.
Governor Andrew Cuomo's always been a champion.
Governor Andrew Cuomo has set out to change that, but even his hand-picked economic development commissioner, the man behind the ads, admits they're not there yet.
There's no denying these reforms and the overall improvement of the business climate are a work in progress.
But simply by talking the talk, New York is plunging itself into a competition that's increasingly intense. State finances across the country have largely recovered from the recession, but job growth still hasn't. That means the states are bringing a lot more firepower into the fight for a handful of jobs.
Governor Cuomo, it is so warm.
Why have more jobs and businesses moved to Texas than any other state?
No state has been more aggressive than Texas, running ads in 6 states, including New York. But now New York is fighting back.
We're the economic capital of the country, obviously. So it's understandable that governments would come here, the mission to try and secure, get our companies to move elsewhere.
New York's newest weapon, a 10-year total tax break for companies that partner with universities in the state, though no company has signed on yet. Texas Governor Perry says he welcomes all competition.
It makes you get up every day and work harder, so we don't take any time off.
The game is on among the states. Now, if only the jobs will follow. Scott Cohn, Nightly Business Report.
And finally tonight, just ahead of the Memorial Day weekend, when the nation honors its fallen soldiers, Sharon Epperson takes a look at some of the benefits available to active duty and retired members of the U.S. Armed Forces, including ones that many veterans might not even know about.
The attacks on the World Trade Center and Pentagon changed Matt Colvin's life and his career. He joined the U.S. Air Force that day.
I joined on September 11, 2001, and that just really set me on a course for a quick indoctrination into the military. And I had already known that that's where I wanted to go, but it just solidified my path.
Colvin rose to the rank of Staff Sergeant during his 6 years of military service. After returning to civilian life, like many veterans, he went to college.
Without the GI Bill, I never would have been able to really take advantage of college, because I would have had to take out the loans, and then I'd be in the same predicament as many other people with this looming debt. And so I thank the GI Bill for that.
The military offers active duty service members, veterans, and their families some of the most generous benefits around. While most know that the military can help pay for college, there may be many other benefits that are not on their radar.
When I got out of the service, I was not aware of any of my benefits except for the GI Bill. And that's really sad. And that's what a lot of veterans go through. They're only aware of maybe one or two of their benefits.
Michelle LaShawn Glass served in the U.S. Army for 4 years. After college, she worked at IBM before setting on a new mission. Now vice president of a national nonprofit credit counseling agency, she educates service members and veterans about benefits that can protect their financial future.
Many of them are hurting. A lot of them don't know about all the benefits that they qualify for. Many of them, when they leave the service, they're not even aware that they should go to the VA and get themselves registered so that they can figure out what their benefits are.
Some of the benefits include more favorable terms on home loans, no down payment, no private mortgage insurance premiums, and limits on closing costs, as well as programs to assist veterans with job training, small business loans, and franchise opportunities.
There are so many organizations out there that want to help veterans. Reach out to one of those organizations and let them help you through the process, but always know that you're not alone.
Veterans can find out which benefits they're qualified to receive at military.com, the government's Veterans Affairs Department, and also get help from nonprofit organizations. Taking the initiative to learn what assistance is available is critical, says Colvin, who now works in New York helping veterans navigate the maze of resources and benefits available to them. For Nightly Business Report, I'm Sharon Epperson.
And they deserve all of those benefits, don't they, Tyler?
They certainly do.
That's Nightly Business Report for tonight. I'm Susie Garib. Thanks for watching.
And I'm Tyler Mathisen. Have a great weekend, everybody. We'll see you back here on Monday night.
I'm Susie Garib with a Nightly Business Report news brief. A new milestone today for the S&P 500. The index closed at 1,900, a new all-time record. Stocks got a big boost from a recovery in sales of newly built homes in April. They shot up a better-than-expected 6.4%, following 2 months of sharp declines. So with home builder shares rallying, the Dow rose 62 points, the Nasdaq was up 31, and the record-setting S&P added 8 points. Now, one of the biggest gainers in the S&P today, Hewlett-Packard. Shares of the computer giant rose 6% after the company's turnaround plans called for as many as 16,000 additional layoffs. But shares of teen retailer Aeropostale tumbled nearly 25% after reporting weak quarterly sales. Be sure to tune in to Nightly Business Report right here on your public television station.